Hi, and welcome to Providence Market Review for December. Although it's a market review for December, well, it's happening in January. So first of all, Happy New Year to all our viewers. And if you do like our content, please like and subscribe on the buttons below, and it will greatly support this channel. So, while it's a sort of titled December 2024 market review, what we're going to look at is actually more of like the full year performance for 2024 across our portfolios on a 1 year and on a 5-year basis. And it's just to highlight, how we've done, some of the things that might derail equity performance in 2025, and also some of the things that we think about to mitigate some of the volatility in our portfolios. So first of all, it's been a great year for our portfolios in 2024. I mean, we have high double-digit returns for our equity portfolio, as you can see, right? Our equity portfolio has about 16.85% returns. These are in Singapore dollars, by the way. So, this is in the currency that most of our clients invest in. Most of our clients are going to be drawing down their portfolios in, going to be spending in. So these are great returns in Singapore dollars. If you look at even something like a 60-40 portfolio, which has 40% bonds, 60% stocks, it's double-digit returns of 11%. That is also very, very good for the year. And something with 80% bonds, short-term bonds, has delivered about 6.4% return. So 2024 has been a good year for our stocks. But of course, at Provident, we don't just look at things on a 1-year basis, right? It's a great year, but how has we done over a longer period of time? And in this next chart, what I show are the 5-year annualized returns in Singapore dollars, right? So this would be akin to something like every year you're getting this return if you invested starting at the start of 2020, which means you would have gone through the market volatility of COVID, which means you would have gone through the inflation shock after that and how the market fell, both stocks and bonds, in 2022. And then after that, the subsequent market recovery. And so as you can see, of course, the numbers are not going to look as exciting because the market has gone up and down. But overall, it's still a very, very good return. We've returned about 9.25%, right, for stocks over a 5-year period. If we look at 60-40, which is about 40% in bonds, and despite the volatility of the bonds, despite the fact that bonds fell a lot in 2022, still getting about 5.5% over 5 years, every year for 5 years. So that's a very good return, and it definitely helps our clients achieve their planning targets. I believe our planning targets that you discuss with our advisors are below all these numbers, except we are very close for the low risk. But aside from that, the rest of our portfolios are definitely meeting the planning targets that we have been discussing with our clients, which is something that we are very, very thankful for, very, very happy that our investment philosophy and investment framework has enabled us to help our clients achieve their targets over this last 5-year period. And I think really the point that I want to make here is that if you look at these numbers, they look great. It looks like everything just went up in a straight line. But you know that that's not true, right? For clients that have been with us for the past 5 years, you experienced COVID, what happened in March in COVID when the market fell a lot, right? Almost 30%, more than 30%, because suddenly the world shut down. You have also been with us through 2022 when bonds fell, when stocks fell, right? And the markets fell into a bear market, and that was also a very challenging time. However, if you look at over time, the returns still turn out to be generally around what we expect them to be, and that's because, staying invested through different cycles in the market will help you capture the returns as long as you make a sensible asset allocation. And I want to highlight that point with this chart right? Because the last 2 years, 2023 and 2024, have been fantastic for stocks, right? Both years, high double-digit returns, right? More than 20% a year. But if you look at this price chart, what does it show you? It shows you that even in fantastic years, I mean, if you were to just look at, what happens in the end of 2024 in, say, a US stock market, you look, oh, wow, the stock market returned more than 20%. Looks like it went up in a straight line. So this is the MSCI All Country World Index. So it includes developed world. So it's got some US stocks, it's got some Japan stocks, it's got European stocks, right? But it also includes emerging markets. So it has Chinese stocks, has India stocks, has Taiwan, has Korea, etc. Right? So it covers a lot of the countries in the world, has an allocation to both developing and emerging markets. So first of all, it did not go up 20% every year, but it did do high teens, right, in 2023 and 2024, which is a fantastic return for stocks. So, but if you look at this chart, what does it tell you? It didn't go up in a straight line, not even in great year, right? Like 2023, everybody remembers it rebounding from what happened in 2022. The markets went up a lot. But look at this period. This is July to October 2023, right? Look at that. It was a period where the market fell quite a bit. In fact, almost back to where it started, right? If you look at this, it almost went to where it started. But then, of course, it rebounded strongly, and then it was a very good year for stocks in 2023. Right? Even in 2024, last year, right, there were periods, right, in March, April, where markets fell. And after that, also July onwards to end of October timeframe where markets fell. And I mean, markets go up and down for various reasons, right? Markets are every day trying to price in all the incoming information. So at this point, it looks like inflation was beaten, and suddenly inflation wasn't beaten. And then after that, the data changed again and inflation was beaten. The Fed started to signal that they will cut rates. With this time, yes, the Fed cut some rates, but then there's also worries about bond yields rising, etc. So, every day prices move and they don't go up in a straight line. And so I guess the point is that, even in a good year, there will be turbulence. And all the more, we must be prepared for turbulence because as we enter into 2025, we have had a strong period for markets, some very, very good years. We have to be prepared that there will be more turbulence ahead, right? So we cannot really expect that there's going to be another double-digit return in 2025. We hope that there will be, and we cannot forecast it. We won't really know how the markets will do. But it would be, say, less realistic to expect that we're going to get double-digit returns, right? Not saying they're going to get negative returns, but we might not get double-digit returns. And so, I mean, positive returns will still be good, but we have to expect that there will be volatility in the markets, in any given year, right? But how do we manage that volatility? And that's very important, right? Because we want to make sure that as clients, you stay invested. Because if you stay invested over a period of time through the volatility, you are able to capture these returns, right, over time. If you have to, sell out halfway, if you can't take the volatility and you exit the market and then try to buy back in again and you start missing, the periods where the market rebounds very quickly, then you will naturally not capture the good returns, right? Imagine if you say you felt very nervous here and you sold out at this point here in 2023 and you said, oh, I don't believe that the market's going to rebound, right? Or the rebound is sort of like a dead cat bounce or something, and you sold out. And then you only bought back in somewhere here. What will happen? You would miss this entire portion, right, of returns, right? And so if that happens, you're not going to capture the overall return of the year because you paid a much higher price versus if you started here and then you just let it go all the way up, right? So that's why we try our best to keep our clients invested, and we do that by managing volatility. And how do we do that? First of all, we focus on asset allocation. Depending on which portfolio, we try to put lower risk assets into certain portfolios that are meant for clients that cannot take so much risk, so that the portfolios are not so volatile. For example, our lower risk portfolios, we include a lot of short-term bonds, because short-term bonds have very low volatility, very low standard deviation, and they, of course, the trade-off is you have a slightly lower return, but that means a lot of less volatility. That helps our clients that cannot take so much risk stay invested. Another one is we ensure that we do a very thorough planning for our clients, where we guide you to the right portfolio mix. If you cannot take the high volatility portfolio like all equity, you can't, if the markets start going down more than 10% over a certain period like this, and then you start to feel like you cannot hold, you want to sell right away, we're not going to guide you into an equity portfolio. We're going to guide you into a portfolio that's got lower volatility, lower risk, with more bonds in it probably. So we do that kind of thorough planning to make sure our clients get into the right portfolio mix. Then lastly, I think we have mentioned this many times to our clients, that we do have a turbulence management plan, right, where we activate if the markets get too volatile, and then we work with our clients to guide them through decision-making process during market volatility, to help them decide, okay, are you able to handle the volatility? Would you like to exit now? Does it make sense? Have you reached your goals, etc.? And then we try to guide them to make sure that they get to the right decision so that they can have a good investment experience. So I've covered a few things that have been on our minds, shared with you how our portfolios have done over a short period of time, over a 5-year period, shared with you how we manage volatility, and also, to expect that there will always be volatility in the markets, even in good years. So I think to sum up, I would just like to share a little bit on what might, affect the equity markets in 2025. We've really had a couple of good years, and let's see some scenarios that might affect the markets negatively. I think one of the key ones would be if there's unexpected inflation globally. I think most central banks right now are seeing that largely inflation has been contained. Right? If we look at the US, Europe, even Japan, they've all not really seeing very strong inflation numbers come through. But of course, that can change, right? So if there's an unexpected event that causes inflation to unexpectedly rise, and central banks might have to adjust their rate forecasts, then that might cause equity markets to see some volatility. I mean, some possibilities are, especially for the US, depending on the incoming administration's policies and how they are able to implement them. I mean, that might drive some kind of budget deficit or larger budget deficit, and that might possibly be inflationary. And if that's the case, then the Fed might be forced to adjust their rate cut expectations. Currently, I think markets are pricing in about 2 rate cuts this year, or even 1 rate cut this year. But now there's a lot of uncertainty around that. So of course, if there's a change in the rate outlook, that will affect the stock markets. And of course, it's not just the US market. I mean, other markets like Europe, Japan, etc., they're also continuing to look at Europe, especially looking at lower rates. However, any adjustment to that outlook will also likely affect the markets. So, I mean, and the last point is really forecasting. It's definitely difficult, right? We look at scenarios, we can think about what might happen, but we really can't predict accurately what will happen. So in this case, these are some of the major themes that might affect markets in 2025. However, we can't be sure how much is already priced in, how much is not yet priced in. So the final takeaway would be, please make sure you have a strong wealth plan, that you know what your long-term goals are, and then do your best to stay invested through the volatility in sensible asset allocations. Stay diversified. Don't just put all your eggs into 1 or 2 concentrated stocks, but stay in a diversified portfolio. And then that is likely to give you a much better investment outcome, investment experience. And well, we look forward to sharing more in the future updates for 2025. Now, I'll pass the time over to Alvin, who will do the market debrief.
All right, thank you, Chye Hsern. Dear client and friends, thank you again for joining us for this month's market debrief. And firstly, I just want to congratulate investors for a spectacular 2024 on your investments. And as we conclude 2024 and enter into 2025, I believe some of us here, we do have that habit of setting a New Year resolution. And your New Year resolution for 2025 might be that you want to lead a healthier lifestyle. And if that is your goal, you cannot run away from avoiding bad habits like consuming sugary drinks, sweets, and even fried stuff. So similarly, when we think about investments, I do encourage all of us to also avoid certain bad habits, such as timing the market and also doing stock picking. So why do we advocate our clients to avoid timing the market and doing stock picking? Let's first look at why we should avoid timing the market. If you look at this study over here, it is on the Russell 3000 index. The Russell 3000 index is basically the 3,000 largest investable companies in USA, and it comprises of about 95% of the investable market in USA. And let's say if you've gone back into time, into 1998, to invest $1,000 into Russell 3000, you realize that by the end of 2022, that $1,000 will have grown to about $6,300. Pretty good returns, I would say. But let's say if you subscribe to the philosophy of trying to time the market, or maybe you feel that markets are a bit high, right? Just like our current situation, if you feel that maybe I should start to sell my investment and just wait for the market to cool off before I enter it in again. So if we were to do that, if we subscribe to market timing and we miss the best 1 week of return, just 1 week of return between 1998 to 2022, you realize that the $1,000, instead of growing to 6,003, it only gone up to about 5,003. Difference of more than $1,000. Okay, so if let's say we have done market timing, we exited the market, and life just suddenly became very busy with work, with family commitments, and we were out of the market and we missed the best 6 months of return, you realize that that $1,000, instead of growing to 6,003, it only went up to about 4,001. Difference of as much as about $2,000. Because no one in this world has a crystal ball to guess whether the market will go up or go down tomorrow. Hence, it is very hard to time the market. And if we were to time the market, we might likely end up with a lower return like in this study over here, compared to if otherwise we would have just stayed invested in our portfolios. So now let's talk about stock picking. So why do we advocate against stock picking? Now let's take a look at the benefits of diversification. If we had invested into a globally diversified portfolio from between 1994 to 2021, the annualized average return would have been about 8.5% per annum. Okay, so but if we were to do stock picking, we just pick a handful of stocks in our portfolio. And if we were to do that and we miss the top 10 performers of each year, you realize that instead of getting an annualized 8.5% return, we are only getting a return of about 4% per annum. If let's say we missed out the top 25% of performers each year, then you realize that our return actually went down to as low as a negative 4.4% return. What this tells us is that, number one, a handful of stocks every year are the one that's mainly driving the returns for the market. And if let's say we picked our stock strongly and we fail to capture the top 10 performers, we end up with a poorer return. So when we diversify our portfolio, it's not just about managing risk, but it is also about casting our net wide enough to capture these top performers when they do show up. In conclusion, if we want to have a pleasant investment experience, we should avoid bad habits such as trying to time the market and doing stock picking. So then how then should we manage our investments? We should always begin with the end in mind. Know what we are investing for. So with that in mind, we will be able to know what's the time horizon that we have to do our investments and what are the risks that we can take for our investments. And that will be able to allow us to stay invested in a globally diversified portfolio to capture the long-term returns of such portfolio. With that, I've come to the end of our market debrief for this month. And as usual, if you have any questions, please feel free to reach out to your trusted advisor at Provident. And on behalf of Provident, I want to wish everyone here a happy Lunar New Year. And for those that are not celebrating, happy holidays ahead. Thank you.